Welcome to Inside Network's INBriefs from our Income and Defensive Asset Symposium. My guest today is Ron Mehmet from Lonsec. Welcome, Ron.
Thank you.
Can you explain Lonsec's basic approach to fixed income portfolio construction?
Yes, sure. What we try to do is provide a portfolio over a 10-year or an economic cycle for our advisors and our clients. And we do that because we're trying to look at from a point of view of providing income and also providing diversification from equities.
Yeah, so you take a portfolio construction view, top down, and
Yes.
then income plays a role.
Exactly.
And then under that, you would design a portfolio appropriate to do those things.
To do those things with the appropriate risk measures of what the client's requirements are.
So what's within the fixed income portfolio? What's the framework and how do you make duration decisions?
Yeah, what we do is we're looking from a dynamic asset allocation point of view with a 3-year time horizon. So we don't play duration from a very short period of time of 3 months or 12 months and looking at whatever data's coming out. We're trying to take a little bit of a longer term picture so that we don't have to incur a lot of transaction costs for our clients.
What inputs do you expect to drive fixed income returns over the next 12 months?
Well, that's an interesting question because we're seeing what the central banks are doing at the moment with hiking rates. That's going to have an impact because of what's going on with inflation spiking up to 41-year highs, that we're going to see more action from those guys. That's going to have an impact and slow down the economy on the demand side, and that will then impact on credit as one of the strategies as well as the economy starts to slow. So it'll be quite interesting to see the balance between what happens with interest rate risk and duration strategies and with credit strategies.
And is credit held within a fixed income portfolio at Lonsec, or is it in alternatives?
No, absolutely. It's in the fixed income side because what we emphasise is diversification over the whole cycle, and that includes duration, that includes credit, and that also includes absolute return type strategies.
So one of the strengths of Lonsec over the last 20 years is your ability to assess a manager's real unique offering. This market must be a really good market to see who's really skilled and who's not. Have you seen anything in the market at the moment that you go, well, that's interesting, they've set their portfolio different to what they were saying? Are you seeing a dispersion between good managers and bad managers at the moment, or has everyone kind of dealt with the higher rates in a good way?
Well, you have that old saying of when the tide's up and all the boats are out there, everyone's doing really, really well. And we saw that for the last few years with great returns of between 5 and 6 and 7 and 8% per annum coming out. Now that we're seeing the rate hikes and we've seen the tide go out, we are seeing a greater dispersion between the different fund managers. And it's really good because we're seeing the reaction and who was prepared for what was happening and who reacted more quickly to what they're doing, interest rate strategies and duration and the hikes and the interest from the central bank. So it's been a very interesting time, and it really has sorted out some of the fund managers. Yeah,
it's interesting. There's a lot more damage out there, but it's more interesting, being a portfolio manager or looking after portfolios because the dispersion is so much greater.
Oh, absolutely, and the attribution is showing it the good, the bad, and the ugly.
So tell me about if I'm going to change this question a little bit, but if your mother, if she's still alive, said, hey, I've got $200,000 and I need one fund, what's the strongest conviction you have within not the full portfolio, but one investment? What would you put that money in?
At this stage, I'd go for absolute return because the emphasis there is on positive returns, and we've had so far this year quite a lot of negative returns because there's too many fund managers that are straitjacketed against benchmarks.
Yes.
And if you leave the benchmarks to one side and you focus on strategy that will give you positive returns like floating rate, that's going to help mum and dad and grandma and grandpa as well, because in the recent past the returns for floating rate have been virtually zero because rates were at historic lows. Now that we're having rates going higher and higher, they're actually going to get 2, 3, 4% returns in the coming years. So the distributions are going to be there in floating rate strategies which weren't there before.
Ron, I have a question. I recently looked on Macquarie's website, and they were offering a term deposit for 2 years at nearly 3.5%. What do you think about term deposits and the new rates? Is that something that we're now used to rates at half, and to me, 3.5% for 2 years looks pretty attractive. What are your views on that?
Well, actually, Bank of Queensland 2 days ago was offering 4% for 1 year.
Wow.
So they're going slowly up and up.
A buyer of term deposits like that, or?
Well, we emphasise, particularly for retirees over the longer term, a 4% return after fees. But if you can get 4% in a term deposit for at least a year, it's a pretty good deal at this stage when you consider that this time last year you're getting 0.35 for 1 year on a term deposit.
And as much as bond returns have looked negative in the last 6 months, I assume, and our firm's doing this, we're adding duration back, because that the yield that you're getting out of some of these portfolios is quite attractive compared to what we're used to.
Absolutely, because with the bond yields now, what they were doing previously were buying bonds at 98 and 99 cents in the dollar. So the return that you were getting over the past year was only about 1%. Now that the rates have been hiked up and the yield curve's gone higher, and we're actually seeing negative returns because yields are up, prices are down. But from a fund manager point of view, is he can go and buy bonds now at 94 cents in the dollar or 95 cents in the dollar.
Yes.
After he's rolled over those ones that are 98, 99 at par, and you hold on to those bonds, and as long as there's no default, they'll go back to 100 cents in the dollar.
Yeah.
So it'll get your money back.
And in a way, that income's a buffer, isn't it?
Exactly. So the yields now you're seeing in fixed interest and fixed income, as you say, are around 5 and 6%.
Yeah, wow.
Which is actually much higher than the 4% I was mentioning a moment ago in term deposits.
Yeah, amazing. Thanks, Ron, for joining us.
Thank you.